Welcome to our reading on financial statement analysis applications. This is a lovely little reading to wrap up our FRA. So our first learning outcome here says evaluate and explain past performance. So the idea here is what we're going to do is compute our ratios and then compare them to the explanations given in the management discussion and analysis. So we're going to compute our ratios, and if they've changed, of course, we're looking for explanations. Why has this ratio changed? Remember, when we do ratio analysis, they don't answer the questions, but what the ratios do is they provide us with the questions to ask the firm's management. Now, of course, one thing we're going to do with our ratios is benchmark them. They mean nothing in isolation. So, of course, let's benchmark against our industry competitors. Do our ratios look better? Do our ratios look worse? And, of course, we're going to do time series as well. So not only cross-sectional with competitors, but look at how the firm's ratios change over time. Are they improving? Are they worsening? Now, of course, it's very important that we ascertain which ratios are critical for success in this company. So what we're going to try and do is look at the ratios that are critical for a competitive advantage. In other words, what are our key performance indicators for this firm? ROE tends to be a very typical one that we look at, the net income generated by the resources in place, the net assets in place, the stockholders' equity. So once we've identified critical ratios that we think are important for this firm to get a competitive advantage, we then need to see how the company performed in these areas. And again, of course, what we're trying to see is, look, did the ratios reflect the business model? And did the ratios reflect the strategy? And really, I'm thinking then, I'm interested in what I can learn about the strategy by looking at the management discussion and analysis. Are we seeing a consistent story being told? In other words, you look at the management discussion and analysis, here the directors are telling you about what the performance has been, where the strengths, where the weaknesses are. Do our ratios support that? Okay, our next learning outcome says forecast net income and cash flow statement. So we've got a little bit of forecasting to do here. So it's quite nice. The idea here is our forecasts are going to be driven by two things. First of all, sales growth. Then we're going to look at ratios in relationship to sales. Now, this does mean that we need relatively constant ratios over time. So we need our gross profit margin to be relatively constant percentage of sales, expenses to be a constant percentage of sales, capex a constant percentage of sales, etc. That way we can forecast future sales, plug them into our ratios to populate an income statement, potentially balance sheets and a cash flow statement. If you've got very volatile ratios as a percentage of sales, this just isn't going to be that meaningful. Now, notice how we're going to do it. We start off by forecasting GDP growth, so we're using a top-down approach. Let's start macro level. Let's start looking at the direction of the economy and hence GDP growth. Now, once you've ascertained what's likely to happen to the broad economy, then we need to drill down to the next level, and of course that's our industry. So what's going to happen to industry sales given the direction of the broad economy? Then, of course, we need to look at our position within the industry. And to do that, we need to look at our market share. Are we expecting it to increase? Are we expecting it to decrease? The purpose of this, of course, is to forecast the firm's sales in the future. So, three-step process: economy, industry, firm. Right, now we've got the forecast firm sales. What we're then going to do is apply those future sales to ratios. Now we're going to be using historical margins, historical gross profit, operating profit, net profit margin. Now remember, gross profit, essentially margin, is gross profit over sales. So if these ratios are relatively constant over time, we can take our forecast, plug it in here, and ascertain what we think gross profit will be. Now, of course, if these ratios are volatile over time, then it's not going to be very meaningful. So we do need relatively stable ratios for this to work. Now, of course, we're going to need to as well look at each individual forecast for each expense item. Not all of our expense items will have a fixed relationship with sales. Our variable costs should. Our variable costs should vary in line with sales by their very definition. But our fixed operating costs may not. So we might need to look at individual forecasts for some of our expense items. Certainly non-recurring items, we need to exclude non-recurring items. Now again, this approach, and we've said it already, using historic margins, historic ratios to sales is not going to be relevant to new industries, volatile industries, or high fixed cost industries. Again, what we're saying is if we're going to use things like profit margins, we need them to be constant over time. That way, by plugging in the sales, we get a good idea of gross profit. If the ratio is bouncing all over the place year to year, then it's not going to be very meaningful. Now, of course, new industries, we don't know what those ratios are likely to be and how they're likely to, and their volatility over time. Volatile industries, very volatile industries, again, the margins aren't going to be constant. And high fixed cost industries. Now, we're talking about fixed versus variable costs here. Definition of a variable cost being anything that varies in line with your sales. Now, of course, we talk about operating leverage and we talk about financial leverage in the income statement. Operating leverage is the level of fixed operating costs. Financial leverage, of course, is the additional fixed costs caused by your capital structure, i.e. interest. If you've got a lot of fixed costs, of course, by definition, they're fixed. They don't vary in line with sales. So as sales fluctuate, they remain static and you get very volatile earnings. So companies with higher fixed costs have more volatile earnings and therefore projecting their earnings as a percentage of sales going forward is going to be less relevant. Okay, so as I said, we need to forecast, our LOS asks us to forecast both net income and cash flow. So we're going to develop a spreadsheet based on growth rate of sales. That's our key driver, remember, sales forecast. That's the first thing we need to start with, that top-down approach, economy, industry, firm. Now, what we're then going to do is make assumptions about our ratios in relation to sales. What is the level of working capital as a percentage of sales? What is fixed asset additions as a percentage of sales? What percentage of cost of goods sold? What percentage of sales are cost of goods sold? Our sales general admin, what percentage of sales are these? Now again, remember, if we're doing this, we're assuming that these ratios are relatively constant over time. Now, certain items, of course, in particular the interest expense in the income statement shouldn't fluctuate in line with sales. That's going to be a function, of course, interest expense of our capital structure. So certain items it does not make sense to look at in relation to sales. Interest expense would be one. Tax rates, well, of course, that's a function of the government's fiscal policy, not our sales level. Now what we're going to do is project net income and cash flow based on these assumptions. So, given the LOS says forecast, we better have a go at doing it. So let's have a look. We forecast sales. Sales next year we think are going to be 100 million and we forecast the growth in sales to be 5% per annum. We believe that cost of goods sold will be a relatively stable 20% of sales and sales general admin will be a relatively stable 40% of sales. Interest income, we've got some interest income here. Now, of course, that's not a function of your sales. That's a function of the amount of cash you've got invested. So we're going to estimate any interest revenue as 5% of our opening cash. Let's have a tax rate of 30%, presumably based on what the current statutory tax rate is and our forecast of future government fiscal policy. We're not having any dividends here. We're forecasting, again, working capital to be approximately 70% of sales. Again, that needs to be stable over time for our forecast to have validity. And we're told that beginning non-cash working capital, this phrase non-cash working capital, when we think of working capital, a lot of us will think current assets minus current liabilities. And that's fine as a definition of working capital. It's just not the definition that we see here. We're using non-cash working capital. And actually this crops up here and also in the indirect cash flow statements. In indirect cash flow statements where we said take net income, add back non-cash charges and deduct the change in working capital, we were talking about non-cash working capital there too. So what is non-cash working capital? It's all of your current assets, excluding cash and investments, and it's all of your current liabilities, excluding any debt items, so any interest-bearing items and any dividends payable. Now, the reason we exclude cash and investments, of course, is they're not part of cash flow from operations. Cash, of course, is part of our reconciliation, is what we're reconciling between, and investments are typically cash flow from investing. Now, as with everything, there's an exception to the rule, and that's trading securities. Current liabilities, we exclude short-term debt instruments, interest-bearing debt instruments, and dividends payable, because those are elements of cash flow from financing. Okay, so what we really want is the working capital that affects our cash flow from operations here. Okay, and then we're saying fixed capital investment, so our CapEx is a function of sales here. It's going to be 5% of sales. Okay, so let's start our little example off here. Let's start off with our sales figure. Year one, we're forecasting it to be 100 million. Our cost of goods sold, if you remember, was 20%. Oh, sorry, first thing I've done is grown it by 5%. So we're essentially multiplying by 1.05 and multiplying by 1.05. A little bit of rounding in year three, of course. So our cost of goods sold is just going to be 20% of the sales figure, and our sales, general and admin, we forecast to be 40% of the sales figure. Our interest, now this was our interest income that we had in this. This was going to be essentially 5% of the opening cash balance. Now, I've given you the figures 0, 1 and 2 here. We need to see the cash really in a second to see where those numbers have come from. That gives us our pre-tax income just by adding down. Taxes, we said we think are going to be a nice constant 30% of pre-tax income, and that's allowed us to arrive at our net income. Now, the figure that we haven't really talked about yet is where these numbers came from. So we're going to need to work out the opening cash. Now, notice in the year one, at the beginning of year one, we've assumed 0 cash. So 5% of 0 is 0 interest. So that's why we've got nothing in at year one. But of course, we've got working capital of 67. I've just brought in the net income for year 1, year 2, and year 3, essentially there from my forecast income statement on the previous slide. Now, our investment in working capital. Our investment in working capital, it said our non-cash working capital will be 70% of sales. Now, if we look at sales then in year 1, 100 million, 70% of that gives us 70 million. Now, given our opening working capital was 67 million, the indication, therefore, is that working capital needs to increase by 3 million to get to the 70 million. So notice in year, there's our working capital projections. Again, notice these are just as a percentage of sales. And remember, we said our assumption here is 70%. So I've just taken 70% of the figures. Now, notice therefore that the investment in working capital is going to be the change. So plus 3, plus 3, plus 4. Okay, so let's have a look at that. There we go, 3, 3, and 4. The investment in fixed capital, well, the investment in fixed capital is 5% of sales. So all we're going to do is just take the change, it's the additions to sales, so 5% of 100, 5% of 105, and 5% of 110 to get our investment in fixed capital. Okay, so net income, less the investment in working capital, less the investment in fixed capital, is going to give us our changing cash. So 20, 22, 22. So we've now got the changing cash. Given we've assumed 0 cash at the start of the period, at the end of the first year, our cash will be 20. At the end of the second year, our cash will be 42. And at the end of the third year, our cash, of course, should be 64. Okay, so going back to the interest that we saw on the previous slide, remember we said 5% of beginning year figures. So in essentially year 2, if we take our 20, multiply by 5%, and we get 1. So that's where the 1 million of interest income came from in year 2 in our forecast on the previous slide. Of course, in year 3, we've got 42 million of cash at the beginning of the year, 5% of that is 2.1. So we've rounded again to the nearest million, and we've used 2 on the previous slide. Nice, so these forecasting, nothing too terrible really with our forecasting. Now our learning outcomes move on to talk about describing the role of financial statement analysis when we're looking at the credit quality of debt. So we're taking on the idea that we're now maybe working for a rating agency and we need to rate the creditworthiness of a company's debt. Now typically the rating agencies use a structure and they look at the 4 C's: the character, the capacity, the collateral, and any covenants. Now, what is the character? The character is really the character of the firm. So what we're really going to look at with character is who is running the firm and what their track record has been. Have they got correct qualifications? What are the internal controls that operate over the firm, etc. Capacity is really looking at their ability to meet interest and principal payments on time. And typically we use a top-down approach here. So we start off with the direction of the economy, then their industry, and then finally down to the firm level. And there's going to be a lot of ratio analysis going on here, such as solvency ratios, such as safety ratios like interest coverage, etc. Collateral is just looking at where the debt ranks on a liquidation, in particular whether the debt has been secured on any assets. Now remember, if debt's been secured on assets, if a company defaults on the interest or principal, then the company can be liquidated and these assets can be used essentially to recover the outstanding principal. So better collateral, better credit rating essentially. And then finally our covenants. And of course we talk about our affirmative covenants, what the company must do, so regular payments of interest and principal, maybe it needs to prepare management accounts on a regular basis, etc. And we talk about negative covenants, things the company cannot do. It cannot maybe issue future debt or additional debt without the permission of the existing debt holders, etc. So we need to look at all of those. Now of course, when we're looking at credit risk, it's all about a cash flow forecast focus. We need to know that the cash the company is generating is sufficient to pay interest and principal when it falls due. So not only are we interested in the size of the current cash flows, but of course the volatility of cash flows over time. The more stable our cash flows are, then of course the better the credit rating will be. So credit scoring, we just need to be aware of a number of factors that the rating agencies are going to look at. So they're going to apply formulas that are weighted averages of, here we go, our accounting ratios and business characteristics. So the first thing they'll look at is the scale of the company. Now, of course, the scale of the company is just its size. And then diversification. Diversification is really looking at the different products that the company produces. Is it over-reliant on one product? That, of course, would be a negative factor. Does it have a lot of different products? And therefore, if one product fails, others hopefully will succeed. And of course, that would be favorable. So we'll look at product diversification, but not just product diversification, geographical diversification as well. Of course, the more geographically diverse we are, the less dependent on any one geographic market the firm is. Operational efficiency, so we're looking at operating return on assets. Often we might use EBIT as our measure of operating profit over total assets. And I quite like this because, of course, total assets is equal to liabilities plus equity. Okay, so of course we're looking at a pre-levered measure of earnings on our numerator. EBIT is before payments of interest, so it's pre-levered. And we're looking at liabilities and equity on our denominator, so it makes sense. Operating margins, so EBIT over sales, of course. Maybe EBITDA margins. So let's subtract depreciation and amortization. EBITDA, of course, is closer to cash flow than EBIT is. What we tend to also find is that EBITDA is more stable over time than EBIT. Why? Depreciation and amortization tend to be two of the most subjective and volatile items in the income statement. Remember, we can change from accelerated to straight line. We can change useful economic lives. We can change salvage values. We do not have to restate prior years. So often when analysts are forecasting margins, they forecast EBITDA rather than EBIT. It tends to be more stable. Degree of vertical integration. Well, vertical integration is talking about your suppliers and your distribution networks. If you own your suppliers, of course, you have vertical integration. On the plus side, of course, it means you have guaranteed supply of raw materials in your production process. On the negative side, it reduces your flexibility. If a new supplier comes along, well, you're rather wedded to your subsidiary that's supplying you, so you can't switch. And of course, that's on the supply side, but also on the distribution networks. Do we own the distribution network? Do we own the end retailer that sells our product, maybe? If we do, plus, we've got guaranteed access to the market. Margin stability. Well, of course, this is looking at our profit margins, operating profit, gross profit margin, net profit margin, and it's looking for stability over time. And I think actually beyond margins, we'd also look at cash flows as well and their stability over time. The more stable our earnings are going to be, then the better our margins are going to, the better our credit ratings are going to be, essentially. We've got greater ability to service both interest and principal. Leverage. Well, the amount of existing debt, our capital structure, of course, debt over equity, or maybe debt over debt plus equity, the percentage of debt in your capital structure, of course. So we're going to look at solvency ratios, but we'll also, of course, look at a lot of our coverage ratios. Remember our very basic coverage ratio, interest coverage, EBIT over the interest expense. Now, we might use EBIT, but again, EBIT is a non-cash measure, so maybe better to look at EBITDA. It's closer to being cash over interest. Or maybe look at some measure of cash flow, maybe CFO over interest. Or maybe even better than that, free cash flow to the firm, pre-levered cash flow over the interest payment. Remember FCFF, free cash flow to the firm, the discretionary cash available to distribute to both debt and equity holders. Okay, so certainly leverage ratios, both in terms of solvency and coverage ratios, are going to be important. Okay, and of course we might look at interest expense, that's what I've put on the bottom, or we might look at the total payment in the year, total debt service. So rather than just interest expense on the denominator, we'd look at interest expense plus any principal payments. Okay, very important part of the credit rating formula. Okay, we move from looking at credit ratings on debt to talk about using financial statement analysis for investment screening for equity investments. So screening, of course, what does it mean? Simply applying a set of criteria to choose equity, to choose investments. Now, what we're trying to do, therefore, is pick investments according to certain desired characteristics. Okay, now, again, we've got a few different investment styles here: growth, value, and market orientated. Growth investors, these are normally momentum strategies. You're looking for companies with good histories of earnings growth, with the logic if earnings have grown strongly in the past, hopefully they will grow strongly going forward. So it's more of a momentum strategy. Value-based investors, well, here we're talking really about the pursuit of alpha. We're looking for undervalued stocks. So we're typically trying to find companies with low relative valuation multiples relative to their industry benchmark. Low PE, low price to book, low price to sales, low price to cash flow. Again, I mean, simply because you've got a low PE ratio doesn't mean you are definitely undervalued, but essentially we need to go and look at the fundamentals of the company, its growth rates, its earnings, its risk, its payout ratios, etc. Market orientated, neither growth or value, different investment strategy. Okay, now the LOS talks about analyst adjustments. It says explain the appropriate adjustments an analyst might want to make to a set of financial accounts. Well, certainly, if we're looking cross-sectionally, i.e. comparing the ratios of different companies, we need to make sure that the accounting principles those companies have chosen are directly comparable. Maybe one company's used FIFO, the other company's used LIFO. So we're certainly going to have to adjust if we're looking at cross-sectional analysis for differences in accounting choices. LIFO versus FIFO we've got in the syllabus. We've got accelerated versus straight line depreciation. We've got our different revenue recognition methods, percentage of completion versus completed contract. We've got the different lease treatments, capital lease versus operating leases. Remember, this is the whole point of FRA here. We're not trying to turn you into bookkeepers. You're an analyst. You need to know how the accounts have been prepared because it affects the comparability of ratios between companies. Now, of course, if you're looking internationally, then we have even greater differences. So we need to be aware of the differences between IFRS and US GAAP. One of the ones we've seen so far is essentially the unrealized, or one that we'll see is unrealized losses on available for sale securities caused by foreign exchange movements. They hit the income statement under IFRS, they go directly to stockholders' equity under US GAAP. So we've seen a lot. LIFO not allowed, essentially, under IFRS as well. So there's a whole host of different differences that we need to be aware of that reduce the comparability of our ratios. Now, the good news is, over time, the differences between IFRS and US GAAP are getting smaller and smaller and smaller. They are harmonizing. Again, ultimately, the goal is to have one set of accounting standards that applies globally. Why? We're global investors these days. If I pick up a Japanese company's accounts, a US company's accounts, a UK company's accounts, I want to know how those accounts have been prepared, and I want them to be comparable. So what kind of analyst adjustments might we need to make? Well, of course, if we're comparing two companies, then we need to look at their financial assets. These are their passively held assets, and here they are, held to maturity, available for sale, trading. Remember, held to maturity, amortized cost in the balance sheet, available for sale, fair value in the balance sheet, unrealized gains and losses directly into equity, and trading securities, what IFRS calls fair value through profit or loss, fair value in the balance sheet, but unrealized gains and losses hitting the income statement. So again, two different companies, two different treatments, going to have a big impact on actually asset values, but also earnings in the income statement. IFRS, as we said, look, yeah, there is a difference between IFRS and US GAAP on available for sale securities. Unrealized gains and losses on debt instruments caused by exchange rate fluctuations have to go to the income statement and not directly into equity. Inventory, well, yeah, FIFO, LIFO, average cost. Of course, we need to move the companies in line. Plant, property and equipment, certainly the depreciation methods, accelerated versus straight line. We might need to make an adjustment for that. We need to look at the accounting estimates in terms of the estimated lives, the useful economic lives, the salvage values, because again, they have an impact on depreciation and therefore not only the asset values in the balance sheet, but earnings in the income statement. Again, if we're looking internationally, then IFRS throws in the additional complication that PP&E and intangibles can be revalued to fair value. US GAAP, of course, does not allow that. Goodwill, internally generated goodwill. So if you built your goodwill over a number of years by developing your relationships with suppliers, customers, etc., then of course it can't be capitalized because we can't put an accurate monetary value on it. Whereas if we've gone out and acquired a subsidiary, then of course the accountants view the goodwill as the difference between what you paid and the share of net assets you've acquired after making fair market value adjustments. So again, one company that's grown organically compared to another company that's grown via an acquisition strategy is going to cause distortions to their financial statements. Off-balance sheet finance, and the biggest source of off-balance sheet finance that remains under both IFRS and US GAAP is the treatment of our operating leases. Now remember, with a finance lease, we recognize an asset, we recognize a liability. Then, of course, the liability is interest-bearing and the asset gets depreciated. Remember, under operating lease, no recognition of asset, no recognition of liability, so it's really going to affect things like our leverage ratio. Equity accounted special purpose entities versus non-qualifying SPEs. Well, look, I think this is really a hangover from some time ago. Shouldn't be an issue now for IFRS and US GAAP. Special purpose entities, in the past under US GAAP, if you were not the majority shareholder, you could avoid consolidation. You could equity account. Now, equity accounting we don't really talk about properly until we hit the level 2 syllabus. But equity accounting means we bring in our share of the associates' net assets into one line in our balance sheet. Now, with special purpose vehicles, the issue behind that is that their net assets are very small. Their equity is very small because they have large assets and very large counterbalancing liabilities. So you bring in your very small share of net assets. Okay, now the problem was companies like Enron were equity accounting their special purpose vehicles when in reality they had the full risk and reward. So maybe we should consolidate instead. Bring in 100% of these special purpose vehicles assets, add them to our assets, 100% of the liabilities, add them to our liabilities. Now, as we said, the idea of being able to equity account special purpose entities has been really stripped out of US GAAP these days. Sale of accounts receivable, this is when you sell your accounts receivable to a special purpose vehicle. Now again, if you have to consolidate that special purpose vehicle, it doesn't make much difference. But if we didn't have to consolidate our special purpose vehicle, then essentially because we've sold our accounts receivable would be lower, but cash would be higher in our company's balance sheet. So it could be sale via a special purpose vehicle, or it could be using a factoring company. A factoring company is essentially a company you sell your accounts receivable to. They advance you a percentage of the face value. They then collect the cash from your customers. So again, a company that sold its accounts receivable, it may appear that it's got very low accounts receivable and higher cash than a company that hasn't.